alarm bells are ringing louder in the U.S. banking sector, signaling a rise in bank failure risks. Today, we're digging deep into the heart of this financial storm. We'll explore key factors like stressed banks struggling with commercial real estate, the impact of unrealized losses, and the ongoing efforts to rescue faltering institutions. Buckle up as we analyze what's rocking the foundations of these financial giants. In the United States, the banking landscape includes about 4,600 institutions, from large to small community banks. These smaller banks number approximately 4,000 and collectively manage assets on par with those of giants like J.P. Morgan Chase, which has $3.2 trillion in assets. Stress has increasingly shifted towards these community banks, especially those holding between $1 and $10 billion in assets. The Claros Group's analysis, which screened regulatory filings, revealed a concerning trend. Banks heavily invested in commercial real estate loans, and those exposed to potential losses due to interest rate changes are under significant strain. This study identified 282 U.S. banks at risk, controlling nearly $900 billion in total assets. Most are smaller lenders, crucial to local economies, particularly in regions away from the coasts. These banks are vital for small to medium-sized enterprises, local governments, and nonprofits, offering personalized services and providing necessary competition against national banking giants. Their presence ensures a diverse range of banking services that might otherwise be monopolized by the largest players. Despite the systemic stress, these institutions are not near insolvency, but are experiencing operational strains that could lead to conservative business decisions, such as reduced investments in branch expansion, technological upgrades, or new hires. These measures subtly erode community resources and economic vitality. Importantly, the FDIC's safety net ensures depositors in these banks up to $250,000, maintaining depositor confidence and system stability, and cushioning the effects of stress on banks and their customers. This insurance helps secure the financial backbone of communities, ensuring ongoing support and stability in the banking system. The U.S. boasts the largest commercial property market in the world, with banks playing a pivotal role in underwriting commercial real estate loans. In the spectrum of banking products, these loans stand alongside consumer loans, commercial and industrial, C&I loans, and residential mortgages. However, regional and smaller banks often display a higher concentration of commercial real estate loans. This isn't necessarily a result of poor decision-making, but rather a lack of scale which limits their competitiveness in other lending areas, such as consumer or residential mortgage lending. These banks find themselves with a greater exposure to commercial real estate due to these constraints. The financial markets closely scrutinize how these banks manage their exposures, the stresses they anticipate, and most crucially, how they are setting aside reserves for potential losses. The dynamics of commercial real estate loans become particularly challenging when the Federal Reserve hikes interest rates. Higher rates can lead to increased loan payments, pushing borrowers towards potential default if they find themselves unable to cope with the rising costs. Federal Reserve Chairman Jerome Powell has openly acknowledged the inevitability of bank failures under such financial pressures. To address these concerns, regulatory bodies have sharpened their focus on banks with significant commercial real estate loan portfolios. Discussions center on whether these institutions fully comprehend the scale of the risks they bear, if they have sufficient capital buffers, and whether their risk assessments and disclosures are both honest and accurate. This ongoing dialogue is crucial for maintaining the stability of not only the banks involved, but also the broader financial system they support. Since March 2022, the Federal Reserve has implemented 11 rate hikes, significantly elevating interest rates from their historical lows. This sharp increase has led to a marked depreciation in the value of fixed-rate assets, embedding substantial unrealized losses within banks' balance sheets. These losses stem from bonds and mortgages initially issued during a period of low interest rates, now diminished in value due to the current higher rate environment. Unrealized losses remain dormant on balance sheets, not yet impacting financial statements until the assets are sold. For instance, a bond yielding 3% purchased before the rate hikes is now less valuable because new bonds reflect the higher interest rates of 6%. This devaluation affects the net interest margin, the core income generator for traditional banks, which relies on paying lower rates on deposits while lending at higher rates. However, as interest rates rise, banks are compelled to offer higher interest on deposits to retain and attract customers, yet many of their loans and securities yield returns at previously lower rates. This scenario narrows their profit margins and could potentially invert the typical banking revenue model. The persistence of these unrealized losses on banks' books is a ticking time bomb that only converts to realized losses if the assets are sold at a depreciated value. This situation underscores a classic case of interest rate risk management, where effective leadership within banks is crucial. Bank executives must navigate these challenging conditions, hoping for a stabilization or reduction in interest rates that could mitigate these potential losses. The expertise in managing such risks determines the resilience and stability of financial institutions in this fluctuating economic landscape. In response to the ongoing banking stress, the Federal Reserve is treading cautiously with interest rate adjustments in 2024. Nonetheless, even potential rate cuts might not alleviate the prevailing pressures on banks. Amidst this economic climate, banks have limited options. Many may choose to scale back operations to align with available capital, a conservative path that could stabilize their financial standing. Regulatory frameworks offer banks some flexibility to assist borrowers struggling with repayments. This can include restructuring loans, extending maturity periods, or reducing interest rates. While these actions might have capital implications, they generally prevent costlier outcomes like borrower defaults. Another avenue for banks is to seek additional capital. The financial markets, ideally, should furnish the necessary capital, steering clear of government bailouts. The issue predominantly lies with banks that are stressed and undercapitalized rather than insolvent. Private sector interventions, therefore, are viewed as more appropriate solutions. Consider the case of New York Community Bank, which successfully raised over $1 billion from investors. This infusion of capital bolstered its balance sheet, potentially enhancing its ability to serve the community more effectively than if it had continued to contract its operations. Mergers and acquisitions are additional strategies for bolstering bank stability. Stronger banks could acquire weaker ones, though market conditions last year saw a significant downturn in bank M&A activity, with fewer than 100 acquisitions, marking a 40-year low and the lowest total acquisition value since 1990 at $4.6 billion. Current equity valuations complicate the merger process, making it challenging for buyers and sellers to agree on price. Moreover, regulatory resistance to mergers and acquisitions is increasing, adding another layer of complexity to these financial strategies. In response to ongoing financial pressures, the Federal Reserve is navigating interest rate adjustments in 2024 with considerable caution. Despite this, potential rate cuts may not sufficiently alleviate the stress experienced by banks. In this challenging economic environment, banks are confronted with a few strategic choices. Many are likely to opt for contraction, scaling back operations to match their existing capital, a conservative approach aimed at stabilizing their financial position. Banks are afforded some leeway by regulatory bodies to aid borrowers who are struggling with repayments. Possible interventions include restructuring loans, extending their maturity, or lowering interest rates. Although these measures might impact capital levels, they are generally preferable to the costly consequences of borrower defaults. Another strategic option for banks is to seek additional capital. The capital markets are expected to provide the necessary funds, advocating for solutions from the private sector rather than relying on government bailouts. The primary issue is not insolvency, but the stress and undercapitalization of these financial institutions. For example, New York Community Bank managed to raise over $1 billion from investors, significantly strengthening its balance sheet. This capital injection aimed to enhance its ability to serve its community more robustly than if it had remained in a downsized mode. Mergers and acquisitions, M&A, also serve as viable strategies for stabilizing banks. Stronger banks have the opportunity to acquire weaker ones. However, the M&A landscape has been tepid, with the previous year marking a 40-year low in bank M&A activity. There were fewer than 100 bank acquisitions, and the total value of these deals was the lowest since 1990, totaling just $4.6 billion. The challenging merger climate, characterized by lower equity valuations, makes it difficult for buyers and sellers to agree on pricing. Furthermore, there is growing regulatory resistance to M&A, adding an additional layer of complexity to these financial maneuvers. This complex environment underscores the critical need for prudent financial management and innovative solutions within the banking sector. As we've explored today, the U.S. banking sector is navigating through a turbulent sea of economic pressures, from rising interest rates causing unrealized losses to the acute stress on smaller banks heavily invested in commercial real estate. But what lies ahead? The coming years will be crucial in shaping not just the future of individual banks, but the stability of the global financial system. Stay tuned, and don't forget to subscribe for more insights and updates on this ongoing financial saga. Thank you for watching, and let's keep a keen eye on how these challenges unfold in the banking world.